All right, ladies and gentlemen, well, welcome to today's um, lecture series. This is January lecture series, and we are looking today at a very important topic, which is Nigeria's new tax laws. And I want to believe that each and every one of us, especially many of us that live in Nigeria, don't even understand taxing and taxation. Please, before I continue, can someone confirm that you can hear me? Just confirm that I'm being heard, please.
Yes, we can hear you.
Thank you, sir. All right, so the whole taxing and tax system is something that I believe even the average Nigerian may not does not understand, and so it's important. And then apart from that, the National Assembly, approved by the president, have commenced a new tax system in Nigeria that we need to understand so that we know how to, um, adjust to the laws of the land that most of us here live in. And so it's important for us to know how this taxation as a whole and the new tax system affect us, mostly as medical doctors. And I know many of us here also are business people. And so how do these new tax laws affect us? How does it affect our lives? Important for us to understand so that we can position ourselves properly and benefit from it and not just be a victim of whatever is coming. So to take this very important topic, I have a distinguished accountant, a man I've worked with closely for some years, who is also happens to be an expert in new tax laws, well, in the taxation system and the new tax laws. And his name is Mr. Wokji Goshit. So I will hand over the floor to him to take us, and after that, we'll take some topics. And Mr. Wokji, welcome. You have the floor.
All right, thank you very much. Good evening, all. Dr. Samuelson, good evening, and everyone on this call. Can you hear me?
Yes, we can.
Okay, all right. I just shared my slide. I don't know if you can see it.
Yes, we can see.
All right, okay. So my name is Wokji Goshit. I've worked with Mr. Samuelson for some time, Dr. Samuelson rather, and I've been in tax practice for some while as a tax administrator and a tax practitioner. Although I've left the tax administration now and I'm partially into tax practice and accounting. So today we'll be looking at the on we'll be looking at the new Nigerian tax laws and how it affects us as individual. So, Dr. Samuelson, how many hours do I have?
About 40 minutes, sir.
Okay, 40 minutes. All
Yes, sir.
right. So we'll just go through the tax laws, what tax is, and each of the laws, and afterwards would have a question and answer series. So I'll just run through the slides and explain what I need to explain. And if I am too fast or if you don't understand, you could just call me back and I'll explain myself. So our agenda for today is we are looking at what is taxation, types of taxes, overview of the Nigerian tax law, that's the new tax reform, and then the key provisions of the 4 acts, the major taxes that affect us as individuals, and then the impacts on the medical profession, and of course, business, and challenges, opportunities, and then questions and answers. So what is taxation? What is taxation? So taxation is or tax rather is a mandatory financial charge imposed by government on individuals, businesses to fund public services, while taxation itself is a system or process of imposing and collecting this tax. So when we talk of tax itself, it's a compulsory levy that has been laid down on individuals or companies. And then, of course, it's not tied to a specific benefit. Most times, if you talk of, when you pay school fee, you're paying a levy or school fee because you know that you are going to be taught, or you have your child is going to be taught, and at the end of the term, there's going to be an assessment. But for this, there's no specific it's not there's no specific benefit. So that is why most times you discover that our government are not so accountable just as it is abroad. But what is taxation? Taxation is the mechanism that brings about the tax itself. So this includes the enforcement, tax laws, just as the new tax laws that are out, and then the principles or the canons that guide taxation, which are fairness, equity, certainty, and a lot of others. So I have a little picture there which says taxation is a price we pay for civilization. I don't know if that's the same with Nigeria. But of course, if we pay our taxes, it helps us to gain more civilization, just as it is outside Nigeria. So what are then the types of taxes? We have, they are majorly divided into two, which is the direct tax and the indirect tax. So for the direct tax, we have the personal income tax. And this personal income tax is divided into two. We have the pay as you earn, which is mostly for workers, people who work and earn salaries. And then we have the direct assessment, which is for the informal sector. That's the way we call it, but some might just call it personal income tax. But for this series of lectures, then would use it as direct assessment, which is the normal nomenclature. But just in case you hear someone say personal income tax, he is not far from the direct assessment. And then we have the company income tax, the petroleum profit tax, education tax, the capital gains tax, and the withholding tax. So now, most times people tend to say, taxation or these new taxes is as a result of the government that just came into power, or that was in 2023, because they say Tinubu is a tax man and he believes in taxes. But if you look at the laws here, you discover that these laws, like for the PIT, which is administered by both the State Internal Revenue Service and the Federal Inland Revenue Service before now, the most recent act that was established to administer the personal income tax was in 2011. And we have it, I think the first act was in 1974, if I'm not mistaken. And then we have that of the company income tax, which was last amended in 2004. The petroleum profit tax was amended last in 2004, though now we don't collect the petroleum profit tax. It's rather collected as the hydrocarbon tax. Then we have the education tax, which was last amended in 2011, the capital gains tax in 2004. while the withholding tax in 2011, that's because the withholding tax doesn't have a specific tax guiding it, but it's rather guided by the Personal Income Tax Act and the Company Income Tax Act. So, of course, these direct taxes are compulsory levies on income of individuals and companies. So, those are direct taxes paid on either your income or the profit of companies. So, then we have the indirect tax. So, the indirect tax are compulsory levies on goods and services. Those ones are not directly, they are not directly on your income or on your profit. So you can have the customs duty, the value added tax, and then the stamp duty, amongst others. So as you can see, the act that or the laws that were guiding these taxes, you can see the Custom Duty Act 2004, the VAT, Value Added Tax Act 2004, and of course the stamp duty in 2004. So now I just kept a small note. The way Nigeria is structured, we have 36 states, including the Federal Capital Territory. And when it comes to personal income tax, each state collects her own tax. So we have what is called the residency rule, which I'll come to later. If I live in Plateau State, I pay, and then I earn my money in Plateau State, and I live in Plateau State, I will be paying my tax to the Plateau State Internal Revenue Service. And if I live in Lagos and earn my money in Lagos, or even if I don't earn in Lagos, but I live in Lagos, I pay my tax, that's my personal income tax, to the Lagos State Internal Revenue Service. And but there are exemptions, for armed forces, the police, those in Ministry of Foreign Affairs, they pay theirs to the Federal Inland Revenue Service. And of course, even those who are not resident in Nigeria, but they earn their income from Nigeria, they pay theirs to the Federal Inland Revenue Service. And before now, even residents of the FCT were paying theirs to Federal Inland Revenue Service, not until some years ago where they established the FCT Internal Revenue Service, where people from the FCT or who live in the FCT pay their taxes, that's the personal income tax, to the FCT Internal Revenue Service. So what it looks like post, I'm talking of post 2025 as at today, the direct tax, of course, the changes, these are some few changes, the direct tax, and then the rates. We have the PIT, which is the personal income tax, the CIT, which is the company income tax. As of today, the new law has spelled out that your tax from the percentage of your tax is from 0 to 25%. It's a progressive tax. But before now, as at last year, as at December 31st, 2025, it was from 7%, or rather, would I say 1% to 24%. So when I say 1%, is that before now, there was what they called minimum tax, which was effective. But as of today, we do not have the minimum tax, which is now zero tax. So before now, the old tax, if you earned something around 300,000 in a year, you're expected to pay the minimum tax, which is 1% of your gross earnings. But in the new law, that's for the personal income tax. If you earn, and then they now increase the range from 300 to they're about 800,000. So if you earn about 800,000 in a year, you're not expected to pay any tax. So when we talk of 800,000 in a year, so monthly, that person's income or salary should be around 70,000 approximately. So for the indirect tax, which is the VAT, we have it's 7%, and the new 7.5% rather. Then we have the zero rated tax, which medical items, although have been, before now, they have been they've not been paying tax on those medical items. That's in terms of VAT. So, but now they have been classified as zero rated. Then we have the development levy. So the development levy is now 4%. So before now, apart from all other taxes, you had some levies like education tax. You had science and technology. You had ITF. All those ones were taxes that were paid independently. And so now, instead of paying all those ones, the new law, that's the new laws, that's out of the new laws. I think it was the Nigerian tax act rather, that spelled this out and said 4% instead of all those other ones should just be deducted from companies. And then they will find a way of splitting it to the education tax. That's those who collect, and that's the TED fund, the ETF, science and technology. You have those research centers and all others. So it is now into one, and then it's all now 4%. So for the government levels, there are different taxes and then with different jurisdictions. So for the federal government, they are responsible for collecting the company income tax, the petroleum tax, value added tax, withholding tax, capital gains tax, but all for companies. Anything that has to do with a company, that is what the federal government collects. And then for states, they collect everything that has to do with individuals. So personal income tax, which is for individuals, is going to states. And then withholding tax for individuals, capital gains tax for individuals goes to the state government. While for the local government, they collect property rates or property taxes. So you discover that, and then all those slaughter, abattoir tax, motorcycle, wheelbarrow, even our road taxes, bicycle tax, radio tax, TV tax is all attributable to the local government. So then, who are taxable persons? And then what is the residency rule? So a taxable person is a person from the age of 18 years, and is someone who is eligible to tax if that person earns any legitimate income. So of course, it's this legitimate source of income can be for individuals. We have for those who are employees, sole proprietors, partners, trustees, and beneficiaries in trust. We have settlement or even executorship. Then now, in Nigeria, we operate on what is called the residency rule. So in the case of an individual, residence is a place which is available for domestic use of such individual within a state in Nigeria on the first day in a relevant tax year. This does not include any hotel, rest house, or other place that is a temporary residence unless no more permanent place is available for his or her use on that day. So now, when we come to the residency rule, it's more common with people who live in Lagos and people who live in Abuja. So you discover that people who work in Lagos but live in Nasarawa State, ideally, they are supposed to pay their tax to Nasarawa State. So you have people who are in Mararaba, you have people who are in the boundaries of Buari around Niger State. They are supposed to pay their taxes to those states where they live, but they work in Abuja. So it's not where you earn your income that you pay the tax, but where you live. That is what the residency rule talks about. And then for those who work in Lagos but live in Ogun, when you live in Ogun, ideally you're supposed to pay your tax to someone who is in Ogun. So aside that, another part of what the residency rule states is that you can have multiple residents, and then maybe you live in Abuja and then you live in Jos. So now, where you pay your tax is where you have lived at least a number of 183 days. So, for instance, you live in in Plateau State, maybe you move from Plateau State to Abuja to Lagos, and you lived for 3 months in Abuja, let's say 3 months in Lagos, and the remaining 6 months in Plateau State. It's expected that your income tax is supposed to go to Plateau State based on this residency rule. But of course, we've had problems in tracking where you've lived and all those other things. So that has become very difficult, but that is just the ideal thing and what is stated in our laws. So personal income tax assessment. So when we talk of income chargeable, we are talking of gains in terms of gains or profit from any trade, business, profession, or vocation for whatever period of time such trade, business, profession, or vocation may have been carried or on or exercised. And of course, when we talk of another chargeable income, that's when it comes to individuals. We are talking of any salary, wage, fee, allowance, or other gains on or profit from employment, including compensation. So now, when we talk of just to differentiate, because the A talks about companies, it's talking about it's referring to trades of companies, while the other one is talking about individuals. So now, in our laws, companies are more like uh, limited liability companies. So if you have a business name or a business venture, if your business is registered as a business name or a business venture, it's classified as an individual. So your taxes or your tax rather goes to the state internal revenue service. While if yours is a limited liability company, a PLC, it goes to the federal government. That is the Federal Inland Revenue Service, now called the Nigerian Revenue Service. So now, would now have an overview of the Nigerians 2025 tax reform. Of course, a background, it was signed on the 26th of June 2025, and its effective date is 1st January 2026. And what has this law done is that it has consolidated over 50 provisions or consolidated over 50 taxes that's in our provisions to simplify, broaden base, and raise revenue. So that's just why, just a background of it. And then the goal of this is for efficiency, equity, and then to increase VAT. As at last year, when the governors forum, when the law was about to be passed, the governors came out and said, sorry, our taxes, what you've done is to reduce our tax. And it's not been fair because in real sense, the taxes of state governments are going to nosedive. And most likely from now, they will be going more on penalty. So if you do not file, if you don't do all those things, because they know that there are no taxes, they might cash in on penalties because they know that there are no taxes for them. Because for instance, if you're in Plateau State, an average Plateau man, let's say, earns around 100,000 to 200,000. And when you look at the tax law, when it comes to personal income tax, you discover that the government, he would not be paying as much as he used to pay before now. So now, when the governors forum went and then they were arguing, what they argued and they placed forward was that their taxes was going to reduce. So, but before now, there was what they call the minimum tax, which is 1%. So if your income is not up to the benchmark. So for instance, if we're going to operate the minimum tax, so for this 800,000, instead of 0%, they would have applied a minimum tax, which is 1%. And then the individual will now pay 1% of 800,000. That's in a year. So what the committee did in alliance with the federal government was to convince the state governments and say, we'll be giving you more VAT. We'll be generating on your behalf because right now they want to go and collect from those who earn higher. and will share to these states. So now, before now, sharing of VAT was 15% to the federal government, 50%, 15% to the federal government, 35% to the local government, and 50% to the state government. But now they decided to now give the state government 55%, while the federal government goes with 10%. So looking at the new four tax acts that were signed in June 2025, we have the Nigerian Tax Act, the Nigerian Tax Administration Act, and then we have the Nigerian Revenue Service Act, and then we have the Joint Revenue Tax Board, the Joint Revenue Board Act. So now, for the Nigerian Tax Act, all those taxes we spoke about earlier on with their acts like the company income tax, the personal income tax, the value added tax, the capital gains tax, the withholding tax, it has now collapsed and collapsed every law into the Nigerian Tax Act. And of course, it has given some exemptions to small businesses. So before now, as at last year, 2025, a small business is a business that has a turnover of about 25 million naira, and a medium business, and then of course that small business pays 0% on when it comes to tax to the federal government, and then medium is classified as any organization that has a revenue of above 25 million to 50 million is classified as a medium company, and they pay 20% of the tax, that's of their profits. That's the company income tax. And then anything above that is classified as a large or a big business. So then the Nigerian Tax Administration Act, which is just to administer, it unifies compliance, and then it looked at e-invoicing, tax identification. So when it comes to tax identification, before now, every state, if you come to Plateau State has her own tax identification number. If you're fortunate to go to Nasarawa and then you want to do something in Nasarawa, you'd have to get another new tax identification. And then if you have anything to do in Lagos or in Abuja, you would have another different tax identification number. So what the Nigerian Tax Administration Act is saying is that now we should have one tax identification number. Then the Nigerian Revenue Service Act rebrands the Federal Inland Revenue to the Nigerian Revenue Service. So now the Nigerian Revenue Service is now the new name. You don't find, there's nothing as at 1st January this year, there was nothing as Federal Inland Revenue Service. So we now have the Nigerian Revenue Service. And then the Nigerian Revenue Service is expected to collect every form of tax or levies, not only the ones that were before collected by them, but now it has now expanded beyond that. And then the Joint Revenue Board Act. Before now, it was the Joint Tax Board. The Joint Tax Board, but I think in their own wisdom, they decided to change the tax to revenue. So it's now the Joint Revenue Board. So the Joint Revenue Board is supposed to work with all the tax administrators, that's from the federal government to the state government and the local government. And what they did in this act is to introduce the tax ombudsman, or and then the tax appeal tribunal. So, but before now, there was the tax appeal tribunal, but this one has now given the tax appeal tribunal stronger powers, or would I say more powers. And for the tax ombudsman, the tax ombudsman is supposed to protect the interest of the taxpayer. So why was this new laws brought? One is for fiscal equity. So it's also to stimulate economic growth. So for fiscal equity, economic growth, competitiveness, tax harmonization, modernization, and sustainable revenue. So that's the reason behind bringing these new laws. So as at the day Tinubu entered office, that was 29th May 2023, the first thing he said was, we're going to take out subsidy, which of course has affected us, would I say negatively? And he said again, Nigeria has so many taxes and would need to harmonize this tax. And I believe that was when they swung into action and they decided to uh, bring in the committee that has been able to unify these taxes. Of course, it hasn't been unified all because there are things that are in the constitution. The constitution is the one that has empowered the federal, state, and local government to collect taxes. But this has only brought, so now, if there's any conflicting, if there's any document that you're using that has to do with tax and it's conflicting with the Nigerian Tax Act, or this amongst these four, the Nigerian Tax Act supersedes any other except the Constitution. So, of course, with this new one, I think most likely, I think what they are doing is to try and amend the Constitution to be able to move along the line of the Nigerian Tax Act. And of course, what this new act has done is for each state also to go and implement her own taxes and pass her own legislation so that it will align with this. And I think most of the states have done that. Zamfara, Plateau State, Lagos, no, Ogun State, I'm not sure of Lagos, and a lot of others have done theirs. And so we'll be looking at each of these tax acts, that's the four of them, to look at the major changes from what it used to be, because from the previous, because there's nothing new in these taxes. I think these people have not brought any new tax. Rather, these were old taxes, and what they just did was to unify and find a common ground. So, what are the common changes in the Nigerian Tax Act? So we have for the PIT, which is the personal income tax, we have zero tax for annual income less than 800,000. So when we say less than 800,000, someone might earn around 1.2 million and still not pay tax. That is only if his rent allowance is up to 500,000. So before you get your chargeable income or taxable income rather, there's what we call, you now get your gross. So for instance, I earn 100,000 monthly. When you multiply 100,000 times 12 is giving me 1.2 million rather. So this 1.2 million is not what is going to be taxed. There's going to be a relief. Before now, there was what we call the consolidated relief allowance, which in the new law has been taken out and then been replaced with rent allowance. So if you have a rent allowance and this rent allowance is, for instance, in Jos, an average two-bedroom flat is there around 500,000 to 1 million. So they are going to relieve you of 20% of that rent. So if your rent in a year is around 1 million, what it means is that 200,000 is your relief. So out of that 1.2 million, you would subtract 200,000, which you'll be left with 1 million. And 800,000 out of that 1 million will not be taxed. It will be tax free. So 800,000 will be tax free. So what will be charged at 15% will be 200,000 naira. So 200,000, 15% of 200,000 is about 30,000 naira. So you divide 30,000 by 12, that will be your tax. So, but for instance, your rent is 5 million. 20% of 5 million is 20% of 5 million is 1 million. So of course, your total income is 1.2 million. But what the law is saying is that you cannot deduct the whole of that whole 1 million as your rent allowance or your rent relief. Rather, they've pegged a 500,000 naira maximum as the rent relief. So even if your rent relief, 20% of your rent is more than 500,000, it is 500,000 that will be deducted as your relief. The next is the company income tax. So for large companies, above 100, so once your turnover is above 100 million, you pay 30%. And once your income is below, your turnover is below 100 million, you pay 0%. But of course, it's not just less than 100 million. Then your assets, your fixed assets should not be more than 250 million. So if your fixed assets are more than or is more than 250 million naira, then you are not going to go tax free. That's 0% tax free. So because the law says 100 not above 100 million and fixed asset of not above 250 million. So if you don't meet both of these thresholds, then you cannot be classified as a small business. So of course, what this law has done again is that if your turnover is not up to 100 million, you're also, apart from the company income tax that you're tax exempt from if you meet the threshold, you're not going to pay capital gains tax and you're not going to pay development levy. So capital gains tax before now was 10%. So when we talk of capital gains tax, is that you bought, let's say a land, you bought it for 1 million. And after some years, you now sold it for 3 million. So you now made a gain on your capital. So on what you invested. So 3 million minus 1 million is giving you 2 million. So before now, as at last year, you would now be charged 10% on the 2 million. So, but what it's saying now is that if at the end of the year, your income is not, your turnover is not more than 100 million and your assets are not, your fixed assets are not more than 250 million, then you are not even going to pay capital gains tax as a company. And then, of course, the same follows for development levy. So then, but again, for individuals, before now, if you sell as an individual and you make that, then you are supposed to be charged that 10%. But now it's saying we are not going to charge you capital gains tax, but rather we are going to put that 2 million as part of your income. So now if, for instance, you earn 5 million and that is your income from your salary and you're able to sell that land for 3 million, after deducting 1 million, that balance of 2 million will be added to your income and then taxed as personal income tax rather than the capital gains tax. So now the next is, of course, for the companies, it's no longer 10%, but 30%. It has been increased for companies. For those who have above 100 million, they will pay 100 million turnover, they will pay 30%. Then the next is VAT, that's the value added tax. Now for medical items, for pharmaceutical items, it is zero rated. That is no VAT for those items. So we have what is called the input VAT and the output VAT. So what this law has also done is that before now, you could not claim input VAT except for direct purchase. Then, but for now, if for instance, you, as a result of your services, let's say you had some things that acquired some input VAT, then you deduct them. Those are more like tax credits that at the end of the day, they would be deducted to your VAT output. So your VAT input are now tax credits that will be deducted in your VAT output. And if there's no VAT output to deduct, then they would refund you your money, or rather it can be deducted in your tax. If there's no tax, of course, you can find some refund. Then there's what is called in the changes. We have in international taxation. There's what is called the minimum effective tax rates. So we have what is called the two-pillar policy in taxation, international taxation. So what this act has done was to implement the pillar two, since the pillar two is what the international tax treaty countries have been working on. I think they are going to implement the pillar one this year. So, but for Nigeria, we've not been doing that. So now for multinational companies, so if you have a multinational company, they are not going to be taxed on the same be at the same or using the same basis as Nigerian companies. But if, for instance, you have, let's say, um, let's say UBA. UBA is a multinational company, and the effective rate when it comes to every nation is 15%. So, for instance, if they are operating in Ghana or in the United Kingdom and they've not been able to pay 15% of that effective rate, when they come back to Nigeria, they are going to be taxed at that 15, the remaining balance of the 15%. And the same thing applies to companies that have interest in organizations that are outside Nigeria. So let's say a Nigerian company has shares in an international company, and the income that is supposed to come to that Nigerian company, when if at in the United States, let's give an instance in the United States, let's say Elon Musk Elon Musk has his company, and then let's say one of the tech companies in Nigeria has some shares. At the end of the day, dividends will be given to the Nigerian company. And so what he's saying is that at the end of the day, if the tax in the United States is not up to 15%, when they send it back to the income back to Nigeria, Nigeria will now deduct the remaining balance to make it an effective rate. And then we have other incentive like the economic development incentive, which is before now, research and development was not a deductible or allowable expense in company income tax. But as at now, you can, if you have for research and development, you can deduct up to 5% of the total income or sorry, of your total revenue as an expense for research and development. Then for the Nigerian Tax Administration Act, um, it has tried to unify tax identification, that's getting one tax identification number. Of course, I think they would be using the NIN for now, and then the mandatory e-invoicing. And of course, if for VAT, let's say you have some input VAT that will be refunded, they are expected to refund that VAT within 30 days. And then now there's a uniform rule for tax compliance enforcement and electronic records. And then, of course, the introduction of the tax ombudsman for independent dispute resolution and tax complaints. Then we have the real-time VAT reporting via a single tax identification number and enhanced dispute mechanism with a tax appeal tribunal. Then we have the third law, which is the third act, which is the Nigerian Revenue Service Act. That Nigerian Revenue Service Act has replaced the FIRS to the Nigerian Revenue Service for centralized federal, state, and local government tax collection, including non-tax revenues, that is others like maybe custom duties, all other organizations that used to collect taxes now used to collect revenues now is going to be collected by the Nigerian Revenue Service. And what's the aim? The aim is for better coordination and revenue optimization. Then we have the the Joint Revenue Board Act. which has now replaced the Joint Tax Board Act and harmonizes federal, states, and then, of course, it brought out the Ombudsman and then the Tax Appeal Tribunal. So before now, the Joint Tax Board is in charge of all the 36 states. So they are the ones that interface with the 36 states and the federal government. So this is for easier cross-level compliance and faster resolution. So when we talk of the personal income tax, the rates, so I just brought out, although I got this from Taiwo Oyedele's page, you have the old rates and then the new rates. If you look at it before now, the first 300,000 was taxed at 7%, then the next 300,000, 11%, then 500 at 15%, and then the highest, anything above 3.2 million was taxed at 24%. While in the new tax law, you have the first 800,000 is at 0%, the next 2.2 million at 15%, and so on and so forth. And then anything above 50 million is taxed at 25%. So, so what are those allowable deductions when we talk of when we come to personal income tax? We have contributions as the National Housing Fund is an allowable deduction, the National Health Insurance Scheme, NHIS. We have the pension. We have interest on loans for developing an own occupied residence. So now, so because this rent, if for instance you're in your own house and you're not renting the house, then you're not supposed to, you're not going to have this relief of 20% on your rent. But rather, if you have interest on any loan to develop your house, then you can claim that. I think that is supposed to be, I think 5%, and then annual amount of any annuity or premium paid for life insurance. That one too. That too is a tax allowable item for personal income tax. Then, of course, we have the rent relief allowance, and then we have the accommodation benefit tax, or what I call it the benefit in kind. So, for employer-owned property, you have the benefit in kind, 5% of property costs. So that is what, or valued cap at 20% of employees' gross income, excluding the benefits. So I think I got this from the Personal Income Tax Act of 2011. This is how your payee is ideally going to be added, because you have the gross before the consolidated relief allowance will be deducted. And this consolidated relief allowance is 20% of your gross income and plus 200,000. But as at now, in the new law, it has been taken out. So we don't have the consolidated relief allowance. Rather, we have the rent allowance or the interest on housing. Then we have the national NHF, that's the housing fund, which hasn't changed, the health insurance, which hasn't changed, the life insurance, gratuities, and pension. So this is for payee. And then for direct assessment, so to get, the only difference is the top, where you get your end income, your profit from professional services, other incomes, and then before you'll be able to get your gross income. So, but down here, your gross income is just your salary times 12, and then it will give you any amount of salary and income you've been earning. You just add it up. So then I would want you to get this tax code. It's going to help you in computing your tax. So for instance, let me just, sorry. So you can just scan through the barcode. It's going to take you straight to the fiscal reforms web page, and then you insert what you need to insert, and it's going to give you. So, for instance, your salary, you put it there, all your deductions, your pension. Your pension is supposed to be 8% of your basic salary, transport, and housing. Then your NHF is housing fund is 2% of your basic. Health insurance is that's three. Is it 2 point? Sorry, NHF is 2.5% of your basic. 2.5% of your basic. So if you have those figures, you put them there, and it's going to give you an average amount of your tax. So let's, because of time, won't be able to go, but you can do that on your own after scanning the barcode. So company income tax. So for company income tax, we said 30% of accessible profits, which is that's what is going to be taxed. Now there's no minimum tax. So minimum tax before now is that you will be taxed 0.05% of tax, and then development levy has now been brought. Then 15% tax rate for businesses with over 20 billion and above. So now those multinational companies, you can only qualify as a multinational company when your income or your turnover is up to 25 billion naira. So, but I think it's an equivalent of about $750,000 thereabout, if I'm not mistaken. So for the company income tax, how is it taxed? So at the end of the day, your turnover or your revenue, you bring it, then you add up any capital gains, then you less allowable expenses, and then you less previous losses. So for instance, you made a loss last year, the law allows you to still take out that loss, and then your capital allowance. So when we say capital allowance, that was also another thing that was I forgot to mention in the act. So capital allowance, before now, it wasn't a straight line method because we had the initial allowance before the annual allowance. So, but now it's a straight line method, which is just the annual allowance, which is going to be taxed. So what this capital allowance means is that, for your assets, most times you're not taxing it. When you apply for depreciation, what it means is that depreciation at the end of the day is not an allowable expense under the Company Income Tax Act. And so now what the revenue service does, that's the Federal Inland Revenue Service, or now rather the Nigerian Revenue Service, is to say, we can't tax since your capital allowance your depreciation is not allowable. And the reason behind it not being allowable is that you have different methods of applying depreciation. So in my own company, I might decide to apply the straight line method. Another might decide to apply the revaluation method, and others might decide to apply different methods of depreciation. But now, so what it does is that it adds back depreciation and deducts the capital allowance, which is a uniform allowance, which stands in for your depreciation. And so after deducting that, it gives you your taxable profit. And then you now charge 30% of that taxable profit. Although in the law, it states that this 30% is supposed to be reduced to 25% as at this year, but only when the president deems it fit to pass that to the National Assembly. So, but we are waiting for them to see what is going to happen there. So, value-added tax. Value-added tax is 7.5% of sales. So it is on goods and services in Nigeria, and its threshold. So if the company does not have a turnover of up to 100 million or up to 100 million sales annually, then of course you are also free from the value-added tax. And then the common exemptions, value-added tax, apart from this threshold, is also exempted on basic food, rent, health care or medical items and pharmaceutical, agriculture, baby products, sanitary, towels, parts, and then land and building. Then our withholding tax. Also, when it comes to withholding tax, if the company does not have a sales of up to 100 million, of course, they are also set free from withholding tax. So you're not allowed to deduct withholding tax for someone whose company is less than, or would I say less than, whose revenue is less than 100 million. Then, of course, withholding tax is a tax credit or an advance tax collected and remitted on behalf of the persons or company. And then if the supply is less than 2 million monthly, of course, you are tax you're not going to be you're tax exempt on withholding tax. So if anyone does any supply to you of less than 2 million, then you cannot deduct withholding tax. So these are the rates for companies and for individuals. So on dividends, it's 10% for company, 10% for individual. Interest, directors fee, 10% for companies, 10% for individuals. And then rent, 10% for companies, 10% for individuals. Then royalty is 10% for companies, 5% for individuals. Contract, 5% each for both companies and individuals. Consultancy fee is 5% for individuals and 10% for companies. Then commission, the same as consulting and supply, is 2%. So for all this is for companies, but for individuals, you can deduct if the person is not working, and then you remit using his or her team. Then the filing periods for each of these taxes. So for the personal income tax, the filing period for direct assessment is 31st March. So you're expected to take all, so when it comes to, I think I have something here. Sorry, let me take it back. So this is for direct assessment. So all this income, you're supposed to take it to the relevant tax authority 31st of March, while that of personal income tax, your employer is supposed to submit that before the 31st of January. So that is as of today. Today is the last day for submission of any payee schedule or payee tax filing. And then if for payment of payee is done on the 10th of the next month, so 10th of February is expected that your employer is supposed to remit your tax, which he has deducted and paid you that salary before the 10th of February. And who is a relevant tax authority for the personal income tax and the pay is the State Internal Revenue Service. And of course, if they don't remit, then they are liable to liability, which is that which they have not paid, plus penalty, plus interest. So penalty is usually 10%, and the interest is at the current CBN interest rate, which is the same for all. While for company income tax, it's they went to file is 6 months after the accounting end, year end. So, for instance, your company operates a January to December year end. It's expected that by June, on or before June, you should have filed your tax remittance, and that is to the Nigerian Revenue Service. And the penalty is the same as liability plus penalty plus interest. So for value added tax, when is it supposed to be filed? It's supposed to be filed monthly. So even if um, you are filing a zero VAT, then it's expected that before the 21st of the next month, you are supposed to file your VAT and make payments. And the same thing applies to withholding tax, which is the 21st day of the next month. And for withholding tax, it is the relevant tax authority is the State Internal Revenue Service and the Nigerian Revenue Service. So why it is like that is because withholding tax can be for companies and can be for individuals. So if it's withholding tax for companies, it's going to the Nigerian Revenue Service, which is the federal government, and if it is for individuals, it goes to the state government. So then, what is the impact on medical professionals and doctors? So now, the impact of this new law on medical professionals and doctors is that you have the zero VAT, which is for medical items, no VAT on medical services, diagnostic, surgery, drugs, device, medical device reduces patient cost. And of course, it reduces patient's cost because, before now, those VATs can increase the cost on patients and then improves cash flow. So the next is that it increases funding. So because of this, it's expected that funds are supposed to be more to the state government because that VAT, 55% goes to the state government, and it's expected that they are supposed to use that to build up primary health cares and the UHCs and improve at least, give a minimum benchmark of at least 15% on health care. Then the personal income tax relief for people who earn less than 800,000 naira. Equals to or less than 800,000 naira in a year. And then for small businesses, of course, they are tax exempted from from CIT and from development levies or tax. So, what's the impact on business people? So, the impact on business on small businesses is that you still have a 0% for CIT for companies that do not have a turnover of up to 100 million naira, and of course, no development levy, and an incentive for research and development, which is the economic development incentive, which has a tax credit for incentive of up to 5%. And then, so that means what it means is that for research and development, you can spend up to 5% of your total revenue on research and development. And for value added tax recovery, full on inputs, that's on input VAT and zero rated essential aids cash flow. So before now, you can't claim input VAT, but as at now, you can claim input VAT and claim it as tax credits. So, of course, we have broader revenue, boost infrastructure, aids business growth. So, because now what it means is that you need to collect more taxes from bigger organizations. So, when you have more taxes from bigger organizations, you'll be able to share it amongst the states and local governments. So, what are the major challenges and opportunities? So, for our challenges, is that there's misinformation. Misinformation, informal sector may resist digital shift. So, right now, the Nigerian Tax Administration Act says that there should be e-invoicing. And of course, the informal sector might resist that. And then allocation of risks or allocation risks, increased revenues not guaranteed for health. So of course, that's part of the challenge. It depends on who is in government. Your governor might not decide to use the increased revenue from the federal government on healthcare or even business support. So at the end of the day, you still have economic constraints. So potential risks, potential high price hikes in healthcare services, and business costs. So, for our businessmen, before now, as at last year, before they opened borders for uh, importation of rice and all those things, the cost of production of rice itself was more than the cost of buying it outside of this country. Why? Because of the high cost of living in Nigeria, the high cost of buying fertilizer, the high cost of buying the crops. So at the end of the day, we had lots of our farmers made lots of losses last year because of high cost of production, high cost of power, high cost of everything. So, but what are the opportunities? It's expected that more revenue for infrastructure, education aids all sector, and then equity, we have progressive tax protects low earners and incentive spur innovations, that's for the research and development. And then, of course, there's an advocacy, that's the use of the tax ombudsman for dispute resolution. So, what are the recommendations? So, for the medical profession, it's meant to, you can, the medical professionals are supposed to advocate for health budgets, at least a minimum of 15% for state allocation. So, what it means is that aside you just sitting down, it's expected that you're supposed to play your politics for the government to at least allocate an expense or a budget around at least a minimum of 15% of their budget and adopt digital tools with training, leverage VAT relief for affordability. And then for the businesses, is that you need to formalize your businesses via the Corporate Affairs Commission, because of course now it's said that you're not supposed to do any business with an individual if the person is not registered. So you need to register your company, whether business name or limited liability company is supposed to be registered. Then of course I dropped a URL here for getting your tax identification number. So you can dial this to retrieve your tax identification number. So you use your NIN, your NIN to get your tax identification number. So in conclusion, in the world, nothing can be said to be certain except death and taxes. That is by Benjamin Franklin. He said this in 1789. Thank you very much. Any questions? I think that's the end.
Thank you so much, Wokji. Thank you for an extensive lecture on our Nigerian new tax laws. It's been an exhaustive one, and I'm grateful for your taking out your time to ensure that we understand this. Thank you so much. God bless you, sir. I don't know if anybody has any questions. If you have questions, now would be a good time to ask your questions. Do we have any questions? While we're waiting for questions, I think that it's important for us to have had this lecture because there was so much misinformation going on concerning these tax laws. I felt like a lot of people in the public did not understand exactly what these tax laws are. But we can see from the presentation of Mr. Wokji that the tax laws are not all bad. I'm very impressed with the fact that the government has tried to harmonize all the taxes, because before now, if you have done any kind of business in Nigeria, you pay a lot of taxes. You pay state tax, you pay local government tax, you pay council tax, you pay so many taxes. But I think that these tax laws have tried to harmonize those tax. I'm also glad to see that if you earn less than or equal to 800,000 naira per annum, you will be tax free, as opposed to paying up to, I think it was almost 11 or 15% tax under the old law, depending on the range of what you earn, you know. So it's a good thing that, and there's a huge chunk of Nigerians that earn less than 800,000 naira um, per annum. Of course, the average doctor um, earns more than that. However, it's also important to note that you can have your rent relief. So you can subtract the percentage of your rent from the tax that you are supposed to pay. Okay. And it's also good to see that there is a tax ombudsman, that someone that is for the people. So someone that can advocate for the people, just in case um the government wants to, you know, maybe some things are wrong, and you have someone at least that can advocate on your behalf with the federal government. And also important to see that if you earn, if you do a business, if you have a company that earns less than or equal to 100 million naira per annum, you also be tax exempt. So these are the key takeaways that I've taken from this lecture. Thank you very much, Mr. Wokji. Before we call it a day, is there anyone that wants to ask a question? Wokji, you can stop sharing your screen now. Is there anyone that wants to ask a question? Let them ask the question now before we call it a day. Okay, someone is asking if house officers are supposed to pay tax. The answer is yes, as long as you earn a legitimate income in Nigeria and it is more than 800,000 naira per year, you are expected to pay a personal income tax. Wokji, am I correct?
Yes, you are very correct. It doesn't matter what you do, whether part-time job, full-time, as long as you earn any amount of money, you're supposed to pay tax. And what it means is that okay, so now even if you don't, what the law says, I think I forgot to say that, is that even if you are tax exempt, that doesn't keep you from filing your tax returns. So even if you are supposed to pay zero tax, even if you're supposed to pay zero tax, it's expected that you file your tax. You file, I got 25 million this year, and then you file it to the relevant tax authority. And then even for individuals, even if you earn below 800,000, it's expected for you to file and tell the State Internal Revenue Service that you earn below, this is what you earn. So they are the ones that will even compute and tell you you're not going to pay your tax because you are below the threshold.
So what if you work for an organization and your tax is withdrawn directly from there? Like most of us that work in hospitals, um, our tax is withdrawn directly from source before the money gets into our account. Are we also supposed to file taxes with or the state revenue services?
Okay. So now your employer does it on your behalf. But when we talk of the ideal is not what we go with most times, but it's expected that at the end of the year, so for instance, now in 2026 December or 2025 December 31st, it's expected that everybody is supposed to go apply for his or her tax clearance certificate. So when you apply for your tax clearance certificate, it's expected that you're going to give all those filings there, and then your tax clearance certificate is going to be issued to you. But of course, if you are working in an organization and the organization pays on your behalf, it's expected that they will file on your behalf because your name and your income will be sent to the relevant tax authority to compute, and then they'll send to the organization.
All right.
And if the organization fails to remit or to deduct your tax, the organization will pay on your behalf.
Okay. Thank you. So that also means that those of us who have businesses, who run some form of businesses, number one, um, you cannot run a business again now without being registered with the Corporate Affairs Commission. No matter how small the business is, even if it is a sole proprietorship, you should be registered with CAC. And if you run a company, then you should find or learn how to file your taxes, because you have to do that individually for your company. That's correct, Wokji.
Yes, yes, very correct. Very correct. So what the law says is, if, for instance, uh, an organization gives a contract to anybody an individual, you're liable to a penalty because it's expected that you're supposed to do it with a body corporate. So when we say body corporate, so what I think is that they want to track the number of companies and then what you earn, all those things, because they can't do that for individuals. So, but they can do that on companies. So you need to be registered with the Corporate Affairs Commission. So if you have a company and you want to do business, you need to do business with a registered company. And as you are yourself, you need to register yourself as a company if you want to do business with others.
Okay, so um, that means that, for example, if say I'm a doctor now, my hospital um, gives me a contract to supply, let's say, IV fluids or injections, um, they should not pay the money into my personal account. I should have a company account that they pay the money to. If not, it'll attract penalties, something like that.
Yes, yes, very true, very correct.
All right. Thank you very much. Do you have any other question? All right. So if we don't have any other questions, I think we can call it a day. Thank you, Mr. Wokji, for showing up and giving us this
Yeah, thank
exhaustive
you very
lecture.
much, sir.
Yes. As
Thank you, sir.
usual,
Well, I can see something from Toby.
okay, a
He said,
question.
yeah, what we are being paid is slated as MDCN allowance. So even NYSC members pay tax. I believe if you've gone to serve, you discover as at that time, when I served, it was 20,000. That uh, was the allowance, but they were paying me 19,800. The 200 naira was the minimum tax of 1%, which was deducted as tax. So if the current people serving, their monies accumulatively is not up to 800,000, then of course they won't be taxed. But of course, if your money is not more than 800,000 in a year, you will not be taxed. So whether you call it whatsoever form of allowance, as long as you earn an income, you're expected to pay tax. Sorry for that. Just that.
Thank you, sir. All right. Thank you, Mr. Wokji. Thank you, everybody, for showing up. I appreciate your time. We'll
Thank you,
call it
sir.
a day today. And as usual, this video will be available on our YouTube channel in the coming days. Thank you. God bless you. Have a beautiful night rest.
Thank you very much.